Let us discuss one comprehensive problem of income from house property. For the assessment year 2018-19, Mr. A submits the following information. His income from business is rupees 10,82,000 and he gives details of his property income. He has two houses, house 1 and house 2. He has given the details of fair rent, municipal valuation, standard rent, actual rent, unrealized rent of the previous year 17-18, unrealized rent of the previous year 16-17. The houses were vacant for certain period of months during the previous year. House 1 was vacant for 2 months, house 2 for 4 months. So he has shown the calculation on loss on account of vacancy. Municipal taxes paid, then repairs, insurance, land revenue, ground rent, etc. Interest on borrowed capital by mortgaged house. So he has mortgaged house number 1 and interest on borrowed capital, the funds are used for construction of house number 2. It's 1,40,000. And the nature of occupation is the house 1 is for let out residence, house 2 is let out for business. We are to determine the gross total income of Mr. A for the assessment year 2018-19. Just have a look on the figures again. Now let us see the solution to the problem. First, house 1. To calculate the gross annual value, we first have to know the reasonable expected rent of the property. So step 1, we have to find out the reasonable expected rent of the property. What is the higher of municipal value or fair rent? But if standard rent is there, then it would be restricted to standard rent. Now if we see in case of house 1, fair rent is 3,50,000, municipal value is 3,60,000, while standard rent is 3 lakh. So higher of fair rent and municipal valuation is 3,60,000, but as standard rent is 3 lakhs, so the reasonable expected rent of property will be 3 lakhs. In step 2, we will see the rent received and receivable after deducting unrealized rent but before adjusting the loss of vacancy. If we see in case of house 1, the rent is 6 lakhs rupees and the unrealized rent is 10,000. So when we deduct 10,000 from 6 lakhs, we get 5,90,000. While deducting unrealized rent, we presume that all conditions that are necessary for getting these deductions are satisfied. So these conditions, we should know that the tenancy was bona fide, the owner has put all efforts to collect the money, the tenant has vacated the property, and the tenant has not in occupation of any other property of the owner. So if such conditions are fulfilled, then unrealized rent can be deducted. In this case, we presume all these conditions are satisfied. Step 3, the amount computed in step 1 and step 2, whichever is higher. So out of 3 lakh and 5,90,000, 5,90,000 is higher. Now from here, if there is a vacancy loss, we will deduct it. In this case, there is a loss of 1 lakh rupees. So we deduct 1 lakh from 5,90,000. So we get 4,90,000, which is the gross annual value of house 1. We think that you should have a fairly good idea for calculation of gross annual value when unrealized rent as well as vacancy loss are there. Now, once we have calculated the gross annual value, we have to deduct the municipal tax. Municipal tax here given is 40,000. One condition to be remembered in case of deduction of municipal tax, that it is deductible on payment basis, not on due basis. If the municipal tax is paid in the year in which it is paid, in that year it is eligible for deduction. It may be paid in advance, it may be paid for past years, but the condition is that it must be paid, and secondly, it must be borne by the landlord. If it is borne by the tenant, then the deduction is not available. So when we deduct municipal tax from gross annual value, we get net annual value. Now there are general deductions under section 24 which are available in the head income from house property. There are two deductions available under section 24. One is standard deduction, which is 30% of rupees 4,50,000. So the rule is 30% of the net annual value. So here 30% of rupees 4,50,000 is 1,35,000. Another deduction under section 24 is interest on borrowed capital. Here Mr. A has borrowed fund on the mortgage of house 1, but he has used the loan for construction of house number 2. So this deduction is not available for house number 1 simply because the house number 1 was mortgaged for the loan. So the interest deductible here for house number 1 is nil. So total deduction under section 24 is 1,35,000. So when we deduct this 1,35,000 from net annual value 4,50,000, we get income from house 1 as 3,15,000. Now let us see the calculation for house 2. We have to calculate the gross annual value. So for calculation of gross annual value, we'll go step 1, step 2, step 3, step 4, step 5 like this. Step 1, we have to find out the reasonable expected rent of the property, which is fair rent or municipal value, whichever is higher. In this case, fair rent is 3,20,000. Municipal valuation is 3,50,000. Higher is 3,50,000. But as standard rent is applicable here, it cannot exceed standard rent. But in this case, standard rent is 5 lakhs, which is much higher than the higher of fair rent and municipal valuation. So out of 3,20,000 and 3,50,000, the higher 3,50,000 will be the expected rent of the property. Step 2, we have to see the rent received or receivable after deducting unrealized rent, but before adjusting loss due to vacancy. So here we have seen that rent received by, in case of house 2, is 4,20,000, and unrealized rent for the previous year is deductible, which is 80,000. So 4,20,000 minus 80,000, we get 3,40,000. Step 3 will be amount computed in step 1 and step 2, whichever is higher. So out of 3,50,000 and 3,40,000, higher is 3,50,000. Now we deduct the loss due to vacancy. Loss due to vacancy, here it is clearly given as rupees 1,40,000. So we deduct loss due to vacancy 1,40,000. So in step 5 we get gross annual value for house 2. In step 3 minus step 4 is 2,10,000. From here we have to deduct the municipal tax, which is paid by the landlord and also borne by the landlord. It is deducted on payment basis. So 50,000 is deducted. We get the net annual value as 1,60,000. From net annual value, there are deductions available under section 24. Two deductions. Number one, standard deduction. What is 30% of the net annual value? That is 30% of 1,60,000. It is 48,000. And interest on borrowed capital, as the borrowed capital is taken for the construction of house 2, so it is allowable for house 2, so it is 1,40,000. So in 1,40,000 total is 1,88,000. We deduct from 1,60,000, which is the net value, net annual value. So the deductions are more. In that case, we will get a negative income from house 2. So house 2 income from house 2 will be minus 28,000. If we calculate the gross total income of Mr. A, so income from house property, house 1 is 3,15,000, house 2 is minus 28,000. So his income from house property comes at 2,78,000. His business income or income from profits and gains of business or profession is 10,82,000. So ultimately, we get the gross total income as 13,69,000.